TheoTrade. This is Don Kaufman. July 29th, 2022. We are seconds after the cash close here on this Friday afternoon with another just ripping rally. As I said just moments ago, the S&P's closed. You realize we actually broke the upper edge of the expected move by just over 70 handles. The entire week, we are expecting $97 of movement. Once again, a blistering move to the upside. Have no fear because we have inflation. You got rate hikes. We have a recession. We won't argue that. And we have a Rippin rally. Talk about bifurcation in the marketplace. All right, let's get down to business here on this weekend's update. A lot. First and foremost, let's talk about how bad news is back to good. You know, throughout the course of the week, obviously we had a lot of data drops. Some of the most important data drops actually came after the Fed announcement. You know, the Fed did, well, precisely what they thought they would do, and that is a 75 basis point hike that was effectively kind of priced into the marketplace. Some people listened to Jerome Powell, thought it was a little bit more dovish. Some people countered that. It just didn't matter. Listen, this market was bent to the upside from the get-go. And I talk about bad news is back to good because the worse the news that's coming out, and by the way, this week held some big news, but no one seemed to pay any attention to the fact that GDP was down, obviously the second quarter. Of course, the only talk of the trading community. Do we call it a recession? You can call it by anything you want to call it. It's 2 consecutive quarters of declining GDP. That ain't good. I don't care what the definition is. Yes, I threw in the title recession. Why? I like to be argumentative, but it's negative news, and yet we're hiking rates. Bad news is back to good. S&Ps, they did not care. We continue to rally to the upside. So again, GDP declines again. The one that was actually the kind of the stinger to the marketplace, I'm actually going to bring this up, was specifically this morning, PCE data came out. Now, for those of you that have absolutely no idea, you know, PCE data, very similar to CPI, but CPI is inflation data. PCE is obviously inflation data. One is actually measuring, you know, expenditures out of pocket. The other one, like PCE data, is actually measuring goods and services, meaning like a box of cereal costs X amount. But wait, they extract food and energy. Nevertheless, the PCE data was flying high, the highest print since 1982. Does inflation even matter at this point? We're in a really precarious place inside of the marketplace. And the reason I was bringing up the PCE data is when it came out this morning, it was the only thing for a brief and fleeting moment. The S&Ps actually sold off a little bit. I just wanted to show you that because this number was downright scary. What it basically said is inflation is incredibly high. That's the number specifically the Fed looks at. Listen, inflation, it's entrenched right now in the economy. And the United States is actually exporting a strong dollar, which is, well, exporting inflation. Hey, at least we're finally exporting something, given the world inflation right now. Nevertheless, the only point to be taken from all of these matters that I just discussed is that, again, you have this marketplace that's bad news is back to good. You know, it's almost like this deranged Goldilocks scenario. If you guys don't remember years ago, the Goldilocks scenario was that as long as the economy remained weak, as long as the economy remained relatively weak, the Fed would actually keep juicing markets, and they called it the Goldilocks scenario. So now we're in like Goldilocks in the upside down, if you understand that. It's the upside down Goldilocks to where the economy right now is actually getting much weaker, but inflation's running hot, and the marketplace hasn't come to the conclusion yet that hot inflation, Fed is not going to take their foot off the accelerator. They're going to push into this. And at some point, this could be a little bit of a breaking point for markets. It's one of the reasons that I don't mind throwing an opinion in here or there. I remain adamantly bearish to the marketplace, and that may bother some of you. That's fine. Listen, what you're seeing inside of the S&Ps at present time, I often say this phrase, this is par for the course. I mean, to see the rally from, you know, 36, 39, all the way here to what, 41. I mean, what are we looking at? Let's just pull it. at a very clean 500-point S&P rally. It's phenomenal. It's magnificent. It's also almost the exact same thing that we saw the last time that we rallied, well, 500 points. I mean, listen, well, it wasn't quite that. It was 41, okay? It was like 4130, which is pretty much where we were, right up to about 4,600. It was close. The point that I'm making is the rally, yeah, it's got some teeth right now. Maybe we get crazy. Maybe we come all the way up to 4211, but have no fear. I mean, some of the price action you're seeing right now, listen, trade, okay, is very different from investment. And we try to look at the economy. We try to make sense of like GDP declining and all this negative news. We're having inflation. We're having rate hikes right now. Yet at the exact same time, we're having a rip and rally. And people try to make sense of that. You don't have to. You have to understand one aspect in here, okay? What drives trade on a day-to-day basis? I know I highlighted this and I know it's ugly, but what drives trade on a day-to-day basis in large part is hedging activity. And what you had today, what you had a little bit of yesterday is, well, yesterday, it was Thursday, we came up, this is the upper, okay? That is the upper edge of the expected move. Getting outside the expected move would kick in every server to have to buy. Why? If anybody's actually caught, okay, short delta, which they absolutely are, there's gamma that actually causes you to have to hedge that. And what happens? We perpetuate into what a lot of people refer to as the gamma squeeze. In effect, what it really breaks down to, and people try to make this so complicated, it's not. Imagine you're a market making firm and you're short delta. That's the sign for delta. You're short delta, okay? Now, the whole idea of a market making firm is not to take a tremendous amount of directional risk. In fact, most market making firms are what we term bona fide hedgers. In effect, what that means, they have to be relatively market neutral. So their delta doesn't have to be exactly, but they try to keep their delta relatively flat, like zero. So if you're negative delta and you come up to the edge of this, right? At this point, that's the happy place. Like this line in the sand, and that line in the sand this week, okay, was 40.59. I talked about it, expressly talked about it on Wednesday night. So after 40.59, anything that, any movement to the upside from that level causes your delta to turn negative. Now, how does a market making firm do hedge off negative delta? By adding positive delta. You have to buy S&P futures. You just buy S&P futures. So what we actually got into today is a bit of a gamma squeeze. And here's the most interesting player in the room is the moment we actually really start to breach the upper edge of the expected move, you start to see these big, nasty volume spikes. And those are indicative of like literally servers hedging the negative delta. And why do we call it a gamma squeeze? Because gamma is the rate of change of delta. And it's actually on a Friday afternoon, like take a look at the SPX. On a Friday afternoon, you have a ton, okay, of gamma risk. Why do you have a ton of gamma risk? Because the options are actually driving into expiration. On expiration is going to carry the most gamma risk. Look how many options the SPX traded today. I bring this up very often, but this, we're talking monumental size. Oh, it's a 2.6 million contracts. Okay, but that's just one product. Whatever, man, it's one product. Yesterday, the entire market did 41 million contracts. Today, the SPX did 2.6 million of them. But again, throw in the spiders in there, the spiders are the most prolific product ever created. They did 7.8. Okay, so add up some spider contracts, a little bit of SPX. What do you have? Yeah, you're over 10 million already. So a quarter of all contract size in the entire marketplace is trading between spiders and SPX, two products. And you wonder why we actually squeeze higher like this when all of a sudden there's, it's kind of some crappy news out there. Again, I thought the PCE data was absolutely, appalling at that point. That's what people are like. That's what they're spending. And it's hideous right now. Again, it's the largest print in PCE data since 1982. Neither here nor there. Does inflation matter? Hey, that's not really a question. It matters. It matters because it wouldn't matter what the S&Ps are going to do. It's not going to matter what earnings are going to do. I want you to think about something. The Fed is not concerned right now with the market. Okay, that's completely my opinion. The Fed's not concerned with the market. What they're concerned with right now is inflation, number one, and jobs, number two. Got to keep inflation under control. Okay, forget about knocking it back down to 2% right now. They're at 9.1% of CPI. 9.1% of CPI. Let's just see if we can get it down to 6%. They have so much work to do. You got to understand, they're going to break something. All right. What do you mean by they're going to break something? Yeah. What are they going to break? They're going to break the bond market? Sure. Why not? They're going to break the S&Ps unequivocally. And at some point, they're going to break the back of the marketplace. What are we looking at right now? How is inflation going to be curbed? By the way, this new package, not to get into politics too much, but the new package that's being prescribed right now as an inflation hedge, it's more spending. It's a lot more spending. And it's actually an increase in tax. Those are the two things you don't want to hear when you have inflation and rate hikes. I mean, that's my own, again, perspective over there. And I'm sure that some people will differ, but you think about spending packages, you're going to spend a lot of money. Government spending is directly related to inflation unequivocally. You can look back to, economists from whatever in history. Okay. Rate hikes are not good for the economy, period. So tax hikes, nobody likes tax hikes, but the bottom line is rate hikes plus tax hikes plus inflation. It's a freaking party. And at the same time, right now, we're seeing a rip and rally. That's why I say bad news is back to good. But again, a lot of this is hedging activity. Now, can this rally persist? As I said, let's get crazy. Let's talk about 42.11. It's a gravity point over here. Do I think we're going to get there? Unsure at this point. There's still a lot of data to come out, even next week, okay, that could make things a little bit more precarious for markets. But at this point in time, okay, I'm even less focused on data. And by the way, yes, next week we're going to see the jobs number. And the jobs number, the employment situation is going to get even more interesting. Because what if the employment situation starts to weaken? Does that make the Fed nervous? Because if all of a sudden there's a lot of people that are out of a job, or the jobs number is bad, is that going to be good for the marketplace? How precarious we really are. And again, that's a question. That's not a comment. There's not even an opinion on that one over there. But if you start to weaken in terms of jobs, and believe me, the Fed's going to pay attention to PCE number. They're absolutely going to pay attention to the jobs. But yeah, we're in a total catch-22. The other aspect that the other aspect you really have to think about is the next Fed announcement is not for like 8 weeks away. So there's going to be all kinds of Fed speak coming out. We'll get some factory orders, a little bit of CPI on the side. Again, it is going to be a party of data, but how the markets are going to react to that negative data could possibly be good for the markets, at least for the time being, because again, we're in that the upside down of Goldilocks. All right, with that, earnings, they're largely bifurcated. One of the things that really struck me this week, I get it. Everybody's like, it doesn't matter, the market's up. I get it. I mean, I poke fun at this, but if you look at like Apple or Amazon, I mean, in terms of earnings, these things, they knocked it out of the park. Meta not so good. Meta's not so good. Google, very mixed bag in Google. Initially reacted, positively, a little bit of a rally over here, was a mixed bag of goods over here. NVIDIA is nowhere near its earnings, but again, got a little bit of a bid back under it. All we're doing is just cruising around. Again, if you looked at Microsoft, down day and then ripped to the upside on the earnings, when you start to think about earnings, anybody and everybody's just focused on the monsters of tech. That's it. Okay, because these are the ones that are actually performing. There's one other sector that's performing extraordinarily well, and that happens to be the energy sector. I mean, the energy sector, if I were these guys right now, I would just hide. I would hide. They made so much money. It's like $20 billion. Talking about specifically ExxonMobil. Their earnings doubled from the previous quarter. I would hide because they're coming for you. Nevertheless, I'm less inclined to look a lot at ExxonMobil. Only to say, though, that ExxonMobil, in terms of market capitalization, you have to pay attention to it now because it's a $400 billion company. Nevertheless, the earnings, when I say they're bifurcated, I was almost poking fun at this between like Apple and Amazon, both ripping to the upside. You kind of feel like there's not going to be any other companies within a few years. Okay. All restaurants will be Taco Bell. Again, another movie reference. Catch that one. Anyway, with that, there's not that much to say other than when I talk about bifurcated earnings, it's disconcerting to see, a firm like Intel take such a large hit. I mean, it's disconcerting because this is a 8-9% move in a day. Obviously, people are talking about Roku. By the way, I would not short Roku in any way, shape, or form. This thing could be a takeover candidate in the very near term. Roku getting absolutely decimated though in the earnings. And again, you could look at something like it's sector by sector, but all over the place. They're getting hit, whether it's Procter & Gamble, which obviously is in a completely different sector than something like Roku, which is a completely different sector than something like Intel, right? I mean, there's communications, there's technology over here, but across the board, tech seems at this point unimpeded. And what surprises me about that is like Google, okay? Why Google? Because Google gets everything pretty much from advertising revenues. Yeah, but Facebook just said their ad revs are down. probably because Apple blocked them in many ways. Nevertheless, okay, I would actually fathom that if the economy is weakening, Google, okay, which is receiving most of the dollars from advertising, and companies like who do you think advertises in there? You know, firms like Walmart, which got a devastating hit and rebounded from it. You have to start asking questions. How much longer can tech actually hold it together in here? With that, I bring up the financials. This week, the financials also had a rip to the upside. If there's one place that I'm going to step in and put in a little bit of a short position, it's the financials. The financials actually lagged the market throughout the course of the week and just caught fire here ultimately on this Friday. But even more specific, I just put a position on expressly inside of none other than Goldman Sachs today. Put a short position on Goldman Sachs, just an in-out spread, and I did that largely predicated on the idea it smashed its expected move last week, obviously off the earnings, hit the upside of expected move today. It made all the the candidacy for a short position in the very near term. All right, onward and upward. So mega market cap basically saved the day. And it's been this way now for months, probably, really since the beginning of the year, the sell side activity in the broader marketplace. Nevertheless, you look at the QQQ. Let's bring up the QQQ and go to a year-to-date percentage. Still down 21%. So, before everybody's starting to high five one another based on a significant rally back in the S&Ps, okay, has anything really changed? Okay, the answer is to me, yeah, because again, we are interpreting right now as very bad news being very good for the marketplace because, again, people are inclined to believe that the Fed is going to spin around. You realize this entire marketplace, okay, it's the house of cards based on Fed and Fed policy. So what does it come down to? Maybe one or two monkeys at the Fed. That's makes me feel warm and fuzzy. Anyway, let's get to something definitive over here. So the mega market cap, rally kind of saves the day on the week. Here's another really interesting. Implied volatility has dropped. Let's actually go look at VIX. We're going to look at VIX a couple times here, but implied volatility has come off. Obviously, in a rally, it should come off. But as implied volatility came off, I want to show you something interesting as it pertains to the SPX, the mother of all products. Once again, we're going to go to the SPX. We're going to drop into add study and go to volatility studies and come up here to historical volatility. Historical volatility is the annualized standard deviation of past stock price movement. I don't want to look at it averaged over 20 days. I want to see, okay, what does this monkey look like in the near term? Because I keep talking about don't you dare sell options for very short durations. Hit apply, hit OK. Want something really interesting? One of the most interesting things I've found on here is, check this out, historical vol, which is realized vol. Okay, HV right now is equivalent, okay, to roughly 22.45%. Okay, but that's short duration, which means in the very short duration, like a 5-day period, a 10-day period, historical volatility is running at about 22%. You go, oh, who cares? Because you should look at implied volatility. You want to see implied volatility in the near duration? Okay, look at this. They crushed the implied volatility here. They're running at like 17%. Now this is an average, and this is an average, and an average. Okay, you realize for 4 days it's averaging like 14%, which means something very interesting. The market is moving significantly more than you're getting paid for. The juice ain't worth the squeeze. You sell short duration premium, you die. It is one of the key statements right now. You sell short duration premium, you die in this marketplace. Okay, there's no hiding behind. Look at the implied volatilities. These things have crushed. We haven't seen implied volatility this low, basically this year. I mean, take a look, 17.75%. All of next week, and this is just about settling out now. All of next week, we're expecting about an $80 expected move. So what do you learn from this? I'm going to tell you exactly what you learn. On an intraday basis, listen to me, be on the buy side of options. The short duration options, be on the buy side. I'm not necessarily in the SPX. If you're going to scalp it all, go into something like the spiders. Okay, if you're going to scalp, go into the QQQ. I'm telling you, okay, the market's moving more than the implied volatility, okay, which means that, if you buy an option, okay, and I'll just open up an option for like Monday's expiration. If you buy an option, an at-the-money option, and you look at its implied volatility, the implied volatility, the at-the-money option, okay, I know I'm looking at a put, but it doesn't matter whether it's a put, whether it's a call. You look at the put's actually, these 411 puts, which is the at-the-money put, okay, they're trading for basically 12.5%, but we're moving at a rate of almost 22%, which makes absolutely no sense. It's worth buying short-dated options right now. For those of you that are a little bit more up the learning curve, you could probably gamma scout beautifully. In fact, I will unequivocally try that next week, which is buying a straddle. I would buy a massive amount of straddles, anywhere from 3 to 5, even 7 days out. I'd buy straddles on a Monday and actually scalp stock against the straddle to continue to neutralize it. So it's completely in play at this point in time, and it's been years since we've seen stuff like this. All right. So the reality of the rally, well, the reality of the rally, okay, is markets obviously they say they can be crazier longer than you can remain solvent. But quite frankly, you have to understand that in most respects, you're probably on borrowed time here. If we are going to rally this next week, we did actually crest to the upside of expected move last week. We smashed expected move this week. And at that point, it is incredibly rare to see 3 breaches of expected move sequentially. Okay. In fact, if you look back in all of the data that we have, all right, you may only find like one instance of the occurrence of 3 breaches to the upside. And again, when I say all of the data we have, all you have to do is look for the highlighted. Do you see 3 highlighted? There's 2 in a row. There's a third maybe the week after a precipitous fall. Nevertheless, okay, here you go. You got 1, 2, 3, but the breaches were not nearly as significant as we just went through. Okay, and all of the data that we have, I believe that's about it. It is hard pressed to find. By the way, in the data that I just showed you there, the 3 breaches to the upside, okay, they were basically mild. This is significant. So for the most part, I would say that the rally this next week, and give you the reality of it, the rally this week is probably going to stall. If we do see upside capacity to the marketplace, I mean, right here at this this 42.11, ironically, the 42.11 is very close to the upside expected move inside of the SPX. All right, onward and bears done, or is this just the beginning? One of the things that everybody keeps asking me is like, is that it for the bears? In fact, all the emails I'm getting flooded with, people are terrified right now of the upside move. Okay, again, purely my opinion. Obviously, I don't think that the bears are done by any stretch of the imagination. I think this is actually the beginning of a move that could be violent again to the downside. This is what markets do. This is, if there's a quintessential bear market rally, I mean, why not? We're in it. Go look back at previous bear market rallies. You don't have to look very far. You only have to look back to, well, just a few months ago when we had that very bear market rally. Oh, we were not in a bear market at that point, but it's still, a 400 or 500 point move to the upside. We dropped precipitously. We rallied again right to the 42.11, came back off huge, and here we are again. Okay. At this point, again, I have a tough time giving any support to the marketplace when, all I've heard for the last, the last 12 years, all I've heard is don't fight the Fed. Well, I got news for you. Don't fight the Fed. Why? What do you think the Fed is doing right now? They're jamming rates, okay, up significantly. All right, couple last things. SKEW. SKEW, I think it moved, okay? SKEW is on the move. There actually is a slight bump higher in SKEW. This is something to watch in the next week because we might be able to get off like Christmas tree spreads. VIX, the only question I have in VIX, where's the floor? We got to be close to it because I'll tell you what, if we hit 20, I am loading the boat in VIX call spreads. It's something I talked about in last week's video. This, I mean, it's just if you have an appetite for VIX trades, this coming week is going to be it. Last, but definitely not least, let's talk just a little bit about SPX expected move. So talked about SPX ad nauseum here. Bottom line with the SPX, okay, we're 70 handles outside of the expected move. And again, I would just want to script this for you. So this week we were looking for plus or minus approximately a $97 move. You got it. And then some. That's what the highlighted candle is. So the upside of the expected move was 40.59. We ended up at 41.30. It's basically 70 handles above expected. Or let's just put it in this terms. You had a 170 point move to the upside in the S&Ps. Okay, put on your big boy pants. It's huge. The thing that really bothers me, and I told you in last weekend's video, in fact, see, here comes the onslaught of volatility. Volatility, as I said last weekend, it didn't necessarily pertain to a downside move. You just knew, okay, that we were primed to make this incredible move. And it had nothing to do with just Fed, right? It had to do with the fact that implied volatility has been getting crushed, and we've been outpacing implied volatility week in and week out. All right, this next week, and again, the implied volatilities are just settling out. We're just about the time I look at this. It's about $80, okay, $80.79. Why do I actually sound surprised with that one? So if you think about this, it's plus or minus, okay, $80.79. You just came off of a move. If the market moved 170 handles, and now we are crushing back down even lower, okay? I don't like it, I don't have to like it, I don't even want to like it. Because I'm going to tell you right now, we have the ability to still make dramatic moves. I do believe that just statistically speaking to the upside is somewhat limited. Again, that 40 to 11 definitely is near and dear to my heart. Nevertheless, okay, risk right now is you can taste it, you can feel it, you can see it. Be careful. Implied volatility is inherently low in short duration options. As I said, you want to be on the buy side of short duration options in this marketplace, and it's a marketplace, again, inflation, you got rate hikes, you got recession, and you got a rip and rally on top of it all. It's going to make for some interesting trade in the coming days. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.